Before we begin, please support the Tamil by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. All right, we're looking at the U.S. market analysis for Thursday, April 9th, 2026. This video presents a direct, informational narration of the source document. So here's what we'll be covering. We'll start with a market overview, then dive into macro indicators. After that, we'll look at positioning, followed by geopolitics. Then we'll get into the technicals for key stocks and sectors. And finally, we'll wrap up with our strategy and market outlook.
Risk disclosure. This document is for informational purposes only and does not constitute investment advice. Investing involves significant risk, including potential loss of principal.
Okay, let's kick things off with Section 1, the market overview, which is all about cautious optimism. What's really interesting here is that the main thing driving the market has shifted. It's not so much about the big picture macro stuff anymore. Instead, everyone's zeroed in on the nitty-gritty details of the geopolitical bargaining that's going on. So, what are those geopolitical drivers? Well, for one, negotiations between Israel and Lebanon are pretty much deadlocked. Then you have the Strait of Hormuz, where we're seeing this drip feed effect. They're limiting passage to just 15 vessels a day. We also saw some after-hours comments from Trump expressing his dissatisfaction. But on a more positive note, there are direct talks scheduled between the U.S. and Iran for this Saturday, which is definitely something the market is watching. And here's a key insight from a strategist on this. They note, the VIX has already fallen below 20. However, oil remains range-bound near $97, suggesting that the underlying geopolitical risk logic has not yet been reversed. So even with volatility down, that sticky oil price tells us the real risk hasn't gone away. All right, moving on to our second section, macro indicators, and we're looking at the data from February. Now, it's important to remember that the market is viewing this February PCE release as a bit of a lagging indicator, especially with everything that's happened since. Let's run through those key readings. The month-over-month PCE came in at 0.4%. Year-over-year, that's 2.8%. The core PCE annual rate was 3.0%. And taking a look at the labor market, initial jobless claims were 219,000, while continuing claims were at 1.794 million. Now, here's the strategist's take on this data. February data do not yet capture the energy spike driven by the Middle East conflict and therefore cannot fully ease inflation concerns. And this really gets to the heart of it. The market is pretty much expecting March's inflation numbers to bounce back up, which, keeps the pressure on the Fed's whole easing narrative. Okay, on to Section 3, where we talk about positioning. And this is a big one, historic CTA covering. The recent technical rebound we've seen, it's been massively driven by these huge institutional flows, specifically a historic amount of short covering. And when we say historic, we mean it. The last two trading sessions have seen the biggest short covering frenzy since all the way back in August 2020. In fact, it ranks in the top 3 for the entire past decade. This is a massive flip in capital, with funds going from being short to becoming aggressive buyers. So let's break down the numbers with this table on CTA forward buying expectations. Current S&P 500 short positioning is sitting at roughly 30 to 35 billion US dollars. The expected buying for next week is projected to be between 34 and 45 billion. A really strong support level to watch is 65.50, and the threshold where you might see a vacuum of sell pressure is in the 67.35 to 67.38 range. And this leads to a fantastic insight from the strategists. 65.50 has become the market's Maginot Line, where strong, stabilizing capital has formed a coordinated bid. So think of that 65.50 level as a major floor. This buying prevents a collapse for sure, but a real breakout higher? That's going to depend on some good news geopolitically. Otherwise, we could just see the market bounce around between 65.50 and 69.81. Now for Section 4, geopolitics and what would constitute a material positive. With those big talks happening on Saturday, it's really crucial to define what a genuinely positive outcome would actually look like for the market. So this begs the question, what is the only valid standard for a material positive event here? And the answer is very clear-cut. The standard is what's called a genuine supply-side turning point. What does that mean in real numbers? It means seeing the daily vessel traffic through the Strait of Hormuz jump from its current level of about 15 ships all the way up to a range of 100 to 500 ships. Anything less than that and the pressure from energy-driven inflation is probably going to stick around. All right, let's get into the technicals in Section 5, focusing on key stocks and sectors.
We'll look at some important index targets and the rotation we're seeing back into what are being called hardcore AI assets. Looking at the latest quantitative models, here are the technical targets to watch. For the S&P 500, or SP1, resistance is right at 67.69, and it's actually being tested as we speak. For the NASDAQ 100 ETF, the QQs, the key resistance zone to the upside is between 617 and 628, and we haven't quite gotten there yet. Now, for those hardcore AI assets everyone's watching, Amazon has broken out, and its next key resistance is 236. Meta is trading within that 500 to 700 band. AMD is really pushing up against its 231 to 241 resistance zone. NVIDIA seems to be capped for now by the 187 to 190 area. Tesla's setup looks pretty attractive as long as it stays above 330 to 338, and TSMC has managed to reclaim that important 351 level. Now, this brings us to a sector divergence warning, which really highlights a clear pair trade that's playing out. The idea is to be long semiconductors and hardware, while at the same time being short traditional software. Why? It's all about the AI narrative. For semis, the story is software enablement. They make the new software possible. But for traditional software, that narrative has completely flipped to software disruption, and that's causing a major valuation collapse in that space. And that brings us to our final section, number 6, strategy and market outlook. Here we're going to pull everything together, the capital flows, the geopolitics, and the earnings, to lay out a clear strategy going forward. So here's the 3-part strategy recommendation. First, you have to recognize that there's a solid floor in the market around that 65.50 level thanks to all the CTA short covering. Second, it makes sense to maintain exposure to those hardcore AI assets that have really strong fundamentals. And third, be decisive about avoiding software companies whose technicals look broken. Final professional risk disclosure. This document does not constitute financial or trading advice. Any investment decision is undertaken solely at the reader's own discretion and risk.